India hasn't started that move yet, so it will continue to grow for at least another 2 decades. Let me put this in context. I think that Nigeria is going to overtake India by the end of the century. So Nigeria is 200 million people today. It's going to double by 2050 and double again to 800 million people by the end of the century. And Nigeria will become the second most populous country in the world. But India will still be the most populous country in the world at the end of this century. So that kind of puts it in context. The second thing to look at is Gen Z. Already, India's 380 million people are in the Gen Z bucket. China only has 200 plus million people in the Gen Z bucket. So Gen Z shows you the way forward for India. So you can be very optimistic on Indian demographics. You can be pessimistic on Chinese demographics.
Simon, is there a way to avoid the middle income trap, or is it kind of the destiny of China? And how much does the geopolitical overlay, the tech rivalry, really prevent that innovation that's needed to drive future growth to happen?
Yeah, Heidi, I mean, look, you're asking the really big question. Does China get old before it gets rich? And most demographic experts think that, yes, it does. Median age is already high, and they haven't hit the magic 25,000 US dollars per capita GDP. So I think, yeah, China does get old before it gets rich. And this is the key difference. Japan was already rich before its population started to shrink. China hasn't quite made it. And I think this is what's keeping the Communist Party awake at night. In fact, if you look back over the last 3, 4, 5 years, many government policy decisions appear to have been rooted in demographics. The education stock clampdowns that we saw, the video gaming clampdowns that we saw, all of these things are about encouraging people to have more kids.
How do you position for that if you're a long-term investor? I mean, some of the things are obvious, right? The boom days for Chinese property are over. You talk about automation and AI. Beyond China and some of these other markets, you already talked about population growth really only happening in places like Africa. Is there ways to get exposure to that?
Yeah, absolutely. Look, Nigeria gives you the glimpse. When I told you Nigeria is going to move to be the second most populous country in the world by the end of this century. And the same is true for the whole of sub-Saharan Africa. The challenge for investors is Africa offers this great opportunity from a demographic point of view, but when you look at it from economics and GDP, it's much more challenging. I guess the way to think about this, and we've written about it in previous research notes, think about the bottom of the pyramid. Everyone's fixated on the top of the economic pyramid, the 0.5%, the 1%, all the wealth. But think about the bottom of the pyramid. Think about low-income consumers. Think about what they're going to spend their money on. So consumer staples in emerging markets outside of China may actually be quite a good bet over a long term.
Some things leave you guessing, like, is this an owl, a cat, or a bat? Meow. MailChimp eliminates the guesswork from email marketing with tools that analyze data from billions of emails to offer suggestions for how to improve engagement and revenue. Guess less and sell more with the #1 email marketing and automation platform. Intuit MailChimp.
Let's talk a little bit about that Asian outperformance. We continue to hear that narrative come through. Is that all about the China momentum?
I think there's a couple of aspects to it. First of all is China momentum. You have the reopening, you have the consumer who has a lot of pent-up demand. The second aspect of it could be some level of, softening of U.S. markets where you have the capital coming out of the U.S. We have a situation where EPS estimates are looking to kind of come down maybe, and you combine that with the fact that the U.S. consumer is starting to tether back on their spending. And so the outlook for the U.S. versus China is just different.
Is Asia also cheaper at the moment? When you look at valuations, where do you find those bargains? And do you look at them in terms of countries, regions, or sectors?
You know what, I'm a global PM, so I have that benefit of going anywhere and buying what makes the most sense. In terms of, though, looking at the valuations for Chinese equities in particular, you have to remember a number of these companies, it wasn't just China that was the country that was locked down. Many of the companies were subject to those same trends. They've not seen the consumer spending, so they're actually under earning. So you've got to be very wary of just looking at a headline PE number, because you're comping that PE against a European market, which has been open this entire time, but they have their own issues, and the US market, which has obviously been on fire here.
How are you computing when it comes to the direction of the US dollar and obviously the impact that has across Asian markets, emerging markets?
I think that the US dollar is one of those currencies which has been a real flight to safety. A lot of people have been focusing, for example, on the movement of the US dollar versus the euro. And you've seen both that currency underperformed the US dollar. It's also underperformed the Swiss franc. But what we're surprised with, and a lot of people are surprised with, the euro's actually held up well versus a basket of other currencies, such as the Japanese yen. So I think that as we look at these currencies, people just tend to focus on the strength of the US market and the strengths of the US currency, but that's not the only trade that we're talking about here.
We've seen a real fall in volatility when it comes to trading in Japanese stocks. Do you expect that rally to continue in light of the tweaks that we've seen from the BOJ on policy?
I think at the moment with the BOJ, we're just waiting for the next announcement to come and about what that means in terms of the long-term outlook for policy. So I think that there's a pause in terms of the implications that has. Some of the things, though, that are very interesting about the Japanese market are the fact that we're seeing wage increases being implemented across such a broad range of companies, and they're announcing these and they're implementing that. One of the key things that we've been looking at is whether or not Japan can sustain 2% inflation. That's really not a question outside, but Japan, even with high commodity prices, is still much lower on its inflation outlook. We're seeing some of those pressures abate, and the question is, can they maintain 2%? And things such as wage increases are permanent. They're also that second derivative effect, and they have a much longer and lasting impact.
I remember we used to talk about the improbability of a soft landing, the improbability of getting this to land in some sort of nice way. And now that's the base case. Do you push back, or do you think that it looks more and more likely that we could get some sort of immaculate disinflation or a soft landing?
I think it's still unlikely. I mean, I think it's true that we're not going to go into recession anytime soon. The economy just has too much forward momentum. If you look at the Atlanta Fed now, a GDP Now forecast, they revised it up by over a percentage point just in the last week. So they're looking for 2.1% growth in the first quarter. Before it was less than 1%, just on the back of last week's data. So I think the economy has quite a bit of momentum. I do think, though, recession is likely in the medium term because the Fed has to push up the unemployment rate by a meaningful amount to generate that slack in the labor market. And every time the Fed has pushed the unemployment rate up by more than half a percentage point, we've always ended up in recession. I just don't see that this time is going to be any different.
Do you think that when we look back from a historical perspective, can write the book on zero rate policies as having ended without any sort of financial accident that was material?
Well, I think all the things that we did to fix the financial system following the great financial crisis has helped a lot. I mean, the banking system's in much better shape, much more capital, much more liquidity, stress test, risk management. So I think the financial system is stronger now. And that's why the Federal Reserve is in some way in control of the process. Once the Fed achieves its objective, they can cut rates. And so if the economy turns out to be weaker than the Fed wants at some point, 6 months, 12 months down the road, the Federal Reserve can cure that pretty quickly because they're going to be at, they're going to be at 5% in terms of rates. There's going to be plenty of room for the Fed to stimulate the economy. That's why Powell, said that, the risk of staying too tight too long is less than the risk of not doing enough because the Fed has the ability to support the time comes.
add more creativity, inspiration to the way we work.
And every time we bring a product to market and a service to market, we've got to find ways to really make sure that that brand purpose comes to life.
This story about Ernie, the Ernie bot this week, not so much looking at the technology, but how advanced do you think this can really push the business of Baidu? Is this a game changer for the business, or are they just still experimenting how this can affect really their broad revenue streams?
Right. I'm in the camp that it's a game changer. And that basically is not only for Baidu, but for the broader China or the global internet space. So we've done many global comparisons with, say, Google and also Microsoft, as well as with China. And what we're seeing is that the potential disruptive impact. So just to tell you about Baidu, so it's historically, a share price has been correlated with the cyclical ad recovery. At the same time, we're seeing a potential structural element to Baidu, given the Ernie chatbot. So the disruptive effect include its core ads market share that will potentially reverse its market share loss. So I think that is the cost segment here. And the second thing is that there are more potential monetization use cases. So chatbot will be the beginning. At the same time, I see the floodgates opening to a potential trajectory in multiple growth drivers.
Wow. Can I still chase the rally though? Because we've seen, when it comes to, the buying, it's been extreme levels and some indications that the stock's already been overbought.
Right, absolutely. That's a valid question. So when we put out the report last week, we're in the front end in terms of putting out the report. So we saw share prices increase by 30% in just the past 5 days. So what we're seeing is that it's time for investors to basically take some profit. And then for the next milestone to watch, it will be the February 22nd earnings report, in which management will provide more guidance. So we're going to see more concrete details on product launch. And obviously, reports have been saying that March would be when they actually launch a product. So there will be many upcoming events to look out for. But I would say that overall, we need to look at what the staying power means. So I will rank it by 3 criteria. Regulations, you need the regulator's blessing, especially for China. And second would be in terms of monetization use cases. And this being very capital and also data intensive. So these would be 3 criteria that I would check in terms of who would be the first movers who have staying power.
Do you think the regulatory environment, since you brought it up, has become more friendly right now for a lot of these innovations?
Yes, absolutely. So I think the core theme last year has been cost optimization for China internet. And now we're shifting gears to many companies chasing growth drivers again. So we saw it for Tencent, in which they're opening up multiple permutations around video accounts. So we're going to see live commerce ramp up this year. And secondly, with the game landscape opening up in terms of regulatory controls, so we're going to see no new game genres and also imported license. So for example, yesterday, as you rightly pointed out, so for Valorant, they're launching the Game League. So I think that's essentially signifies that Chinese game companies are switching on the lights after 2 years of haphazard game license launch and also freezes.
And just given what we've seen at Aegis Tech, we've climbed back about half of the losses so far. I'm just wondering, is that still where you chase the online gaming? What are still the opportunities you think?
Right, I would say the opportunity lies with quality laggards. So one thing I would rate would be NetEase. So basically, the market had previously low expectations. At the same time, so given that reopening has been a age old, and also I'm kind of sick of repeating the old story. So I think the focus here now would be in terms of indirect beneficiaries, and we see that ad would be a late cycle play relatively to the e-commerce and also the online travel names. At the same time, so games, given we typically see a 6 to 9 month lag between game license approval and launch, so we essentially see back-end loaded revenue booking towards the end of this year.
So we're coming up into earnings season, right? And a lot of analysts pointing to the fact that we are up 50% on price, and do we get that follow through on earnings? Do you think we'll get earnings growth this year? What type of earnings growth do you think, at least for the stocks under your coverage? What are we talking about here?
Good question here. So I think what we see in the past 3 months was a beta rally, right? So I think right now, what stocks will have more legs to run here will be those with secular drivers. And for the names that I highlighted for Tencent and NetEase, so these are our top picks. At the same time, I would want to raise Kuaishou. So Kuaishou, it is bang in line in the theme of secular growth in terms of short videoization for China. So not only does it have ad recovery component, at the same time, so we expect ad take rates, ad load to further increase, which will be the driver along with live streaming e-commerce.
I think Kuaishou, your price target, correct me if I'm wrong, it's about $90, 91?
Yep.
How did you come up with that number?
Yeah, so basically we do it by a PS valuation approach, right? So a lot of times we
Price to sales.
Yeah, that's
Okay.
right.
Okay.
Okay, I think out of all your ratings, you have one underperform, and that's iQIYI.
Correct.
So are you thinking live streaming? That's something that we shouldn't look into this year?
I would say that for iQIYI, so it's very similar to a long form video. And what I see is that in terms of the China internet landscape, you're basically seeing short videos cannibalize the long videos market share. So when iQIYI, its business model is very much ad driven, but very much similar to Netflix, unless it has further costs in which it will drive a flywheel in terms of cost and also a vicious cycle when it comes to cost increases, that otherwise you will continue to see subscriber decline.
The thing that's different about a Vrbo vacation home, you always have the whole place to yourself. No stranger at the dinner table making things awkward, or in another room taking up space. It's just you and your people. Because why would you ever share your vacation home with someone you wouldn't share your vacation with?
Note after note in the inbox this morning calls for caution. Strategists sounding the alarm after stocks surged to start the year. Morgan Stanley's Mike Wilson expecting the rally to reverse course, writing the following: while it may take a bit longer for the market to price out materially below consensus view on earnings, we remain convicted in our thesis. JP Morgan's Mislav Matejka echoing that view, recommending investors use strength to reduce exposure, and Goldman's David Kostin warning that the recent gains might. Jay Pawlowski joins us now to discuss. Jay, wonderful to catch up with you, sir. Let's talk about those views we just got from JP Morgan, Morgan Stanley and Goldman, and apply them to the US market before you and I talk China, EM and Europe. Are you on the same side as them when it comes to US equities?
Well, I mean, John, I think we have to acknowledge that several of those they're not going to capitulate now. I mean, I think our view for the S&P this year has always been kind of a flattish year, right? Plus or minus 5 or 10%, limited upside on earnings, starting point valuation quite high, rates unlikely to go lower. We've never been believers in the recession, as you know very well. We've been soft landing believers. And so no surprise that when you get a jobs number like on Friday, immediately you have to price out the recession, which, let's remember, 5 weeks ago was the most anticipated recession ever. We wrote about that last week in Narrative Speed. So you've got to flip that script. No more recession. Rates back up at the long end, dollar strengthens a little bit, and it's a perfect reason to take some profits on what, as you point out, has been, like a serious rock and roll start to the year.
Well, Jay, let's talk about that rock and roll start. You were also looking for a major move away from big cap tech, and the Nasdaq just posted a 15% return year to date. What's in that? What's behind it?
Yeah, well, rates coming down sharply, right? Which was what was pricing in the recession. So we had a huge rally in bonds, which we were not believers in, did not really participate in. I mean, you're not going to get it all right, John, right? I mean, there's going to be a few things even guys like me miss. That's part of the game. So we didn't buy that recession impact on the long end, which supported the tech stocks. And now that stuff's being a little bit unwound. We think that tech is going to continue to be an anchor and a cap on the upside of the U.S. equity market. It's still 20+% of the S&P, and rates are not going lower, in our opinion, because we're not going to have a recession, and therefore that caps the upside of big tech, and big tech caps the upside of the U.S. equity market on a relative basis.
What a day for our alma mater, the first ever Lecture from Mars.
We discovered that Canadian University alumni can save a bundle on home and auto insurance. It's incredible bundled savings for alumni.
Take a moment, save a bundle. Visit sonnet.ca.
What are the biggest inconsistencies right now in markets? And I ask this because a lot of people have been saying that bond markets are hearing what Fed Chair Jay Powell is saying, the actual words, whereas stock markets are just hearing that he said disinflation a couple times.
Yeah, I couldn't agree more. To us, the U.S. equity market is fighting the Fed big time. There are some major disconnects in how the equity market is positioning itself. We saw, a huge short covering rally. We saw, a low quality dimension to the rally, and now most recently we've seen cyclicals outperforming more defensive stocks. What's precarious about that is that we have almost all the cyclical linked indicators, meaning recession linked indicators, like the index of leading economic indicators, which has really plummeted, and yet it's disconnected from this cyclical outperformance. So, I've heard the theories that people say, yes, we understand what should happen, but we're going to look through it. I don't know how far their crystal ball goes to look through it, but history is not kind to these kind of, massive disconnects.
Add more creativity, inspiration to the way we work.
And every time we bring a product to market and a service to market, we've got to find ways to really make sure that that brand purpose comes to life.
I think there are practical implications for getting a clear picture of the economy and setting appropriate monetary policy. And it's also a reminder for me about the trust I bear as a public official. Most practically, if I had focused only on core inflation over the last 2 years and tended to look past increases for food and energy, and especially for housing, I would have missed an alarming increase in overall inflation. And I would have reacted more slowly than my Federal Reserve colleagues, and I appropriately did to start bringing down inflation. The Federal Open Market Committee raised interest rates more quickly than it had in over 40 years in 2022. And I think the progress we've made on inflation shows how important it was for us to act so urgently and aggressive in 2022. Just as importantly, excluding those prices would have neglected how much hardship this high inflation would have been for many people, especially lower income individuals and families. High inflation is a very different experience when you are effectively paying a much higher rate than others. When a higher share of your expenses and income are being spent on necessities, and when you have little in savings to draw on, as lower income people do. When I talk about how important it is to win this inflation fight that we're in, it is partly in recognition of this inescapable reality for millions of American citizens. Fortunately, there are signs that food, energy, and shelter prices will moderate this year. An important factor has been the Federal Reserve's ongoing fight to lower inflation through tighter monetary policy. We are seeing that effort begin to pay off, but we have farther to go. And it might be a long fight, with interest rates higher for longer than some are currently expecting. But I will not hesitate to do what is needed to get my job done.
It's going to be how Erdogan reacts and is seen to react and to deliver in this crisis. So far, what is the judgment call on the government's response to the quake?
Well, there's a phrase that Reuters used in its headline for the story on this morning: crescendo of criticism facing Erdogan and his government at the moment. And imagine this: there are thousands of people stuck outside in -5 degrees Celsius temperatures, afraid to go indoors if their homes even exist anymore, if they can even find a place to go. Many of them sleeping in their cars, burning park benches for fuel. Now, Erdogan has made some promises here, including he is promised to supply basic things like gas canisters for heating, 10,000 lira to every family, and he's promised to relocate some of the displaced. But this can't come fast enough for him because he is fighting an already tight race for re-election come May. Now, officials tell us, according to Bloomberg sources, that he does want to continue holding the election on May 14th. That was the date he outlined before this disaster. That would be just after the end of a 3-month state of emergency in much of the affected areas. Unclear whether he can actually pull that off. But the criticism of the crisis response, both the speed of the response, some of the changes, the policy changes his government has imposed that have limited the ability of NGOs to operate in this area. And then finally, we've seen a spat with Twitter over the past couple hours because access was restricted, and an opposition figure appealed to the head of the largest opposition group, appealed to people to use VPNs so that their voices could continue to be heard on the platform.
Add more creativity, inspiration to the way